Assalamualaikum and selamat sejahtera. So we are at the part 2 of the financial management for business startup. For the second part of financial management lecture, the aim is the students will be able to explain the use of financial statements information for their business analysis. Financial statement analysis. So we already know from the previous lecture what constitute as financial statement. Financial statement kita ada income statement, and then kita ada balance sheet dan juga cash flow statement. So we do analysis on these three financial statements in order to know basic company's health, financial health. Let's look at the first one, that is financial ratio analysis. A method of expressing the relationship between any two elements on financial statements. So previous lecture in the part 1, we know that there are 5 elements. Okay, that is revenue, expense, asset, liability, and owner's equity. And we also specifically know that the revenue as expense is expressed in the income statement, while the asset, liability, and equity, these are expressed in this balance sheet. So the relationship is expressed in terms of either percentage, a rate, or simple proportion. So it can be like whether we want to do analysis between the revenue and assets, for example, or between the assets with the liability. So let's look at the type of ratio analysis. We have 4 here. The first one is the liquidity. Liquidity ratio measures the short-term ability of the company to pay its maturing obligations and to meet unexpected needs for cash. So short-term creditors, such as suppliers, are particularly interested in assessing the company's liquidity. So this ratio can be used to determine the company's ability to pay, especially on the short-term debt, by looking at the current ratio. You can look or refer to our textbooks for further information on how to do calculation for the current ratio. The second ratio is leverage, or also known as solvency ratio. It measures the total financing provided by its long-term creditors. So liquidity, we look at the short-term financing or creditors. In the leverage or solvency, we look at the long-term creditors. So the ratios involved here is the debt to asset ratio. This ratio is important to assess the company's financial risk. So the long-term creditors really interested in company's long-term solvency, and especially the company's ability to pay the interest as it comes due, and the company's ability to repay the face value of debt at maturity. The debt to assets ratio measures the percentage of total financing provided by creditors. So the formula, total liability divided by total assets. Higher the percentage of debts to assets, the greater risk that the company may be unable to meet its maturing obligation. The third ratio is operating ratio. It helps entrepreneurs to evaluate the company's performance and indicate how effectively their business are using their resources. So the formulas that useful is the average collection period, the inventory turnover. If you look further in the textbook, you're going to have more ratio, for example, the accounts receivable turnover, the average collection period, and total asset turnover. The last ratio here is the profitability ratio. It indicates how efficiently a company being managed, the ability of the company to use the resources to generate a profit. Example of the ratio is the net profit margin and return on asset. A company's income or profit is very important because it can affect this company's ability to obtain debt or equity financing. So as a consequences, creditors and investors are particularly very interested in evaluating company's profitability. So they may use this, okay, the net profit margin, return on asset ratio, as the ultimate test of the management operating effectiveness. Okay, interpreting the financial ratio, business owners need to understand on how to interpret the ratio and then do the comparison within across the industry and within the different segment of the same industry. So first, look at the intra-company basis. This is a comparison within a company. They are useful to detect changes in financial relationship and significant trends. For example, IOI Plantation Berhad, the current year cash with the previous year cash amount shows whether an increase or decrease. So this is just within one company, okay? IOI Plantation. And the next one is the intercompany. Intercompany means comparison with other company. So to provide the insight into the company's competitive position. Right, so we have IOI Plantation, and then we're going to have another company, okay? For example, Sime Darby Plantation. So the investor can compare between IOI Plantation Berhad total sales for the year with the total sale of its competitors, is Sime Darby Plantations within the palm oil industry. Next looks at the industry averages. Comparison between industry average provide information about the company's relative position within the industry. Okay, for example, we have here the whole industry of palm oil. You can check how many companies sit in stay in or categorized under the palm oil industry in the Bursa Malaysia, and we can compare how does the IOI score compared to the industry average score. So usually the data for palm oil industry you can check from MPOB, Malaysian Palm Oil Board economy data. So you can check how much is the average the palm oil industry average ratio and so on. So what do all these numbers mean? The goal is to achieve ratios that are better than the industry average. And if you found the outlier, you got to understand why the figures are out of the line. And you can do the figures over time, maybe 5 years trend, and or maybe just comparison within 2 years trend. So all ratios are just a snapshot of the situation in a single period. Okay, the next financial statements analysis, we have vertical and horizontal analysis. Okay, vertical analysis, also known as common size analysis, is a technique for evaluating the financial statement data that express each item, in the financial statement as a percentage of base amount. So the formula will be the items that you want to analysis and divided by the base. For the balance sheet, the base amount is the total assets, while the income statement, the base statement is net sales. For example, in the balance sheet, we might express, let's look at balance sheet, we might express the current asset here, okay, current assets, as a 22%, 22.6% of the total assets. So the total asset is being the base amount. Or on the income statement, we might express the selling expenses, okay, selling expenses here, as a 28% of the net sales. Okay, net sales as being the base amount. Horizontal analysis, which also known as trend analysis, is a technique for evaluating a series of financial statement data over a period of time. For example, here we have a comparison between 2019 and 2020. So the purpose is to determine whether there's an increase or decrease that has taken place, and it can be expressed either in amount or as a percentage. The formula is given here: the current year amount minus the base year amount divided by the base year amount. So who will be the base year amount? If you will take a month that is the earliest one. For example, in here we have 2 years here. The year amount is 2 year. The earliest year is 2019. So any items or amounts from the 2019 will become the base year amount. So you can check how each item figure here, you can check using this formula. Break-even analysis. So the important concept in break-even analysis is we call it as break-even point. Break-even point happens when the level of sales, dollar or units, at which it neither earns a profit nor incurs a loss. So we learned previously that if sales or revenue minus expense, so you will get net profit amount if sales is more than expense. If sales less than expense, then you will get net loss. Now here in a break-even point, you got to know what is the sales revenue or point where the results would be neither incur profit or net loss. So what happened here is the points where you get neither profit or loss, or you can say is equals to 0. So why we do this is useful planning tools because it shows the entrepreneurs the minimum level of activity. For example, in this case, how much sales that we must target, okay, in order to require for us to stay in the business. So we have to know how much is our sales volume, how much is our cost or expense, how much is the profit, and other relevant factors. Okay, let's look at the formula to calculate the break-even analysis. It starts with the understanding that break-even is a position where business have zero profit. A level that is not profitable, no losses. So the formula to determine break-even starts from this equation where the profit is equals to revenue minus the expenses. So revenue, how to calculate revenue is the sales price per unit, okay, the RM, and multiple with the quantity of sold. And then the expenses is total fixed cost plus total variable cost. What is total fixed cost? Where no changes in total with the changes of quantity produced. So also means costs that remain the same in total regardless of changes in activity level. For example, monthly office rental. You ataupun monthly shop rental. So you buka kedai ke, tak buka kedai ke, sewa tetap kena bayar. Okay. Walaupun there's no changes. Okay, remember no changes in total with changes of quantity produced. Next one is the total variable cost. What does it mean? Total cost varies according to the quantity of production. For example, raw material. So variable cost is actually cost that varies in total directly, proportionally change with activity level. For example, raw material ni kan, katakanlah kita nak buat roti. Okay, apakah bahan raw material untuk roti? Ialah tepung. So lebih tinggi ataupun lebih banyak unit roti yang kita produce, lebih banyaklah tepung yang akan digunakan. So kalau meningkat roti 10%, penggunaan tepung pun juga akan meningkat proportionally 10%. Okay, next is from the formula X. From the previous slide, okay, dia nampak the X tu, okay, from the formula X, profit is equals to sales price per unit, okay, darab dengan quantity, minus the fixed cost and variable cost, okay, minus both of this. So in order to get the break-even point, profit must be equals to 0. Okay, profit is equal to 0, equals to sales price darab X. X is referring to the quantity, tolak dengan fixed cost and variable cost. Okay, variable cost is going to be variable cost per unit. So contribution margins is derived from the sales price per unit tolak dengan variable cost per unit. Okay, and from this formula, you get X. Kita nak ambil, we want to know how much is the value of this X. What is X? X is the quantity needed to achieve profit levels equals to 0, or also known as the break-even level. So X is equals to A ataupun fixed cost. Kita tengok sini fixed cost bahagi dengan divided by sales price per unit minus variable cost per unit. So this this thing is also known as the contribution margin per unit. Okay, let's look at the example in the next slide. Okay, when you look at the situation, you need to determine first how much is the fixed cost, and then how much is the variable cost per unit, and sales price. These are the things that you need to determine, or the information needed in order to calculate the break-even point. Okay, next. We can express the information from the previous slide into a contribution margin income statement, where sales minus variable cost is equals to contribution margin minus the fixed cost, and we get the net profit. And we have to show how much the price per unit and the quantity and the total. So fill in the information, and we know that sales is 50 ringgit, variable cost is 35 ringgit, and we will get a contribution margin of 15 ringgit per unit. And the total fixed cost is 1,500, and the net profits must be equals to 0. So what you need to know is how much is the quantity or units in order to meet the net profits equals to 0. This we can also look at the point where the total revenue is equals to the total cost. Okay, total cost ada dua komponen, fixed cost and variable cost. Okay, let's calculate the example. Step 1, you have to calculate the total fixed cost. Total fixed cost is represented by the rental and salary, and therefore we have a total fixed cost 1,500. The step 2 is to calculate the contribution margin per unit. Is represented by sales price minus variable cost per unit. So sales price is 50 ringgit minus 35 ringgit the variable cost per unit. So you get contribution margin 15 ringgit. So we already have all the information needed to use the formula. So 1,500 divided by 15. How do you get this? Fixed cost, okay, divide by the contribution margin per unit, variable cost per unit. So fixed cost is 1,500 divided by, okay, contribution margin per unit kan, and okay. So the answer is 100 unit. So how to read this answer? Look at the paragraph here. 100 bouquet of flowers must be sold to reach break-even point. If he can sell more than this quantity, there will be a profit. But if less than 100 units, Azam will be trading at a loss. So using this break-even formula, we have the answer of 100 units. So 100 units, where if you sell at 100 unit means that you get a break-even point, means that the profit is equals to 0. So if you want to get more than this, means that you want to score profit, you have to sell more than 100 units. If you sell less than 100 units, then you will get or trade at a loss. Alright, though, so that's the end of part two, and also means the end of the chapter for financial management.